Good day, and welcome to another Anti-Money Laundering Outreach session presented by the Anti-Money Laundering, Anti-Terrorist Financing (AML) (ATF) Department of the Bermuda Monetary Authority, also known as the Authority, or BMA, and the Financial Intelligence Agency. Today's presentation is part of a series of ongoing outreach seminars that the authority conducts with regulated financial institutions. The goal is to meet regularly with regulated financial institutions to ensure industry sectors are updated on changes to the regulations, areas of the Financial Action Task Force's FATF focus, and areas where sectors are doing well or need to focus on improvement. We hope this engagement will increase the dialogue on critical issues, strengthen the industry's AML, ATF systems and controls, and improve compliance. Today's presentation will provide a high-level overview of the AML, ATF regulated insurance sector, discussing money laundering and terrorist financing risks and red flags, and preventive measures. The presentation will also cover supervisory insights, typologies, suspicious activity reporting guidance, and provide a list of useful resources for sector stakeholders. This slide lists key pieces of AML, ATF, and sanctions legislation and regulations which impact the AML, ATF regulated insurance sectors. Companies should note that the International Sanctions Act 2003 is a standalone piece of legislation, separate from the AML, ATF legislation. This session will primarily focus on the 2008 Proceeds of Crime AML, ATF regulations, central to regulated financial institutions. Developing a robust AML framework is taking a risk-based approach. A risk-based approach does not negate the requirement to meet all obligations outlined in the regulations. Rather, the company must identify, assess, and understand its risk, and implement appropriate mitigation controls and measures. In doing so, the company may consider factors such as the nature, size, and complexity of the business when determining the allocation of resources, following the consideration of all risk factors. This heat map is taken from Bermuda's 2020 National Risk Assessment, or NRA, and shows that the inherent risk for money laundering within the AML, ATF regulated insurance sector is medium-high. This rating was driven primarily by the long-term direct segment and its predominantly international client base of approximately 98%. Altogether, the associated transactions and policies in the long-term direct segment had a high dollar value measured in the hundreds of millions. Therefore, the scale of proceeds that can potentially be laundered through this long-term subsector is significant. The other segments of the subsector, such as insurance managers, insurance brokers, and insurance marketplaces, are less exposed to money laundering threats. It is important to note that the money laundering risk rating in 2020 remained unchanged from the 2017 NR8 despite expanding the scope of analysis to include product risk across the segments. The 2017 NRA only considered the client base due to limitations in the available data. Regarding terrorist financing risk, it was established that Bermuda's terrorist financing risk was low in the previous two NRAs. While there is no evidence that Bermuda is a source of terrorist financing, the jurisdiction has made a number of recommendations to strengthen its anti-terrorist financing framework to ensure that the regime remains robust and can adapt appropriately to any emerging terrorist financing threats. Bermuda will conduct another NRA this year to assess any changes to risks. This slide highlights sector-specific red flags commonly leading to suspicious activity report filings with the FIA. Some red flags include customers that are legal entities whose structure makes it difficult to identify the ultimate beneficial owner or controlling interests. The policyholder and/or the beneficiary of the contract are part of a company whose structure makes it challenging to identify the beneficial owner. For example, multiple layers, or because the company's ownership structure crosses jurisdictions. The policyholder and/or the beneficiary of the contract are part of a company with nominee shareholders and/or shares in bearer form, occupation with a low average income, and the policy has high ongoing deposits, history within an occupation with a higher risk for money laundering or terrorist financing due to local crime, typologies, high access to cash-based businesses, or international exposure. Customers who are reluctant to provide identifying information when purchasing a product, or who provide minimal or seemingly fictitious information. Customers who transfer the contract to another insurer, which would likely be considered a lower risk after a long relationship, and a higher risk after a short period, especially where high fees are involved. Insurers who are made aware of a change in beneficiary only when the claim is made. Customers who incur a high cost by seeking early termination of a product and unusual or excessive customer requests to change or increase the sums insured and/or the premium payments. It is important to note that this list is not exhaustive, and of course, new red flags are being identified as we continue collecting data on money laundering and terrorist financing cases. Further, red flags can be found within the FATF document published in October 2018, titled Guidance for a Risk-Based Approach. The purpose of this slide is to highlight sector-specific trends and MLTF typologies. Politically exposed persons, PEPs, are misusing universal life insurance policies to launder the proceeds of corruption. Predicate offenses include the misappropriation of funds, criminal conspiracy, and insider trading, premium fraud. This is the purchase of insurance policies with illegal or illicit funds, followed by policy cancellation and refund requests. Cash redeemable features allow for the payment of policy premiums and top UPAs, followed by the policy being surrendered, and collusion between introducing agents and brokers. This is the creation of policies and/or the modification of coverage to facilitate the movement of illicit funds. This heightens the need to assess the effectiveness of any reliance and/or outsourcing arrangements. In any outsourcing or reliance situation, the regulated entity retains ultimate responsibility for compliance with a requirement of the POCR, as this responsibility cannot be delegated. Having considered the MLTF landscape from a sectoral perspective, we will now look at its implications for each company. Once a company has an understanding of the sectoral money laundering threats and vulnerabilities, it is positioned to prepare a business risk assessment, also known as a BRA. The assessment considers risks specific to both the sector and the company based on its business profile and risk appetite. Stage 1 is identifying and assessing a company's inherent risks. At a minimum, each long-term insurer, insurance manager, and insurance broker should be able to identify 4 main risk categories. The 4 minimum risk categories are customer, geographic or country, product and/or service, and delivery channel risks. When we look at the 4 different categories of risk factors for the insurance sector, the main threats and vulnerabilities lie within the customer risk and the product and service risk. Regarding long-term insurers, or LTIs, it has already been communicated that the nature of the products offered in the long-term direct insurance sector, 98% of the business, is foreign and poses significantly higher inherent risks. Stage 2 is assessing the likelihood of a risk occurring and its impact. Once all the relevant risks have been identified, it is important to assess the likelihood and impact of the money laundering risks that a business could be exposed to based on the identified risk factors. For example, some LTIs focus on international high net worth individuals who often come with high risk factors, such as the nature of their business regarding the source of funds and the source of wealth, versus customers with fewer risk factors. Stage 3 involves applying the appropriate controls. The next step would be implementing the proper AML/ATF controls, such as a documented policy and procedure manual. The appropriate systems include technology for housing data or a screening process. In addition, the compliance officer and money laundering reporting officer, also known as an MLRO, must be fit and proper, appropriately trained, and understand the risks of the business. Stage 4 is reviewing the residual risk and reviewing the BRA annually or more frequently as changes occur. As a closing comment concerning the business risk assessment, it is necessary to connect its relevance to the risk-based approach previously mentioned. Essentially, a risk-based approach permeates everything related to AML/ATF compliance. As such, the business risk assessment is the foundation of any risk-based approach towards compliance and enables a company to identify, assess, and understand its risks based on the business plan and sectoral risk factors. Therefore, once the BRA is complete, it is important to note that the process should be dynamic, with risk assessments and mitigation measures being refreshed on a regular basis. Following the assessment, the company can best structure its customer risk assessment and dedicate the appropriate level of oversight with the appropriate frequency to each customer. We will discuss the BRA in greater detail at another outreach session. However, we wanted to briefly summarize the process for today's session. This slide briefly outlines the obligations AML/ATF regulated insurance sectors find the most challenging. However, before discussing this further, it is important to provide an overview of a few key regulations that the authority utilizes when assessing a regulated financial institution's compliance. Customer due diligence, or CDD. The application of CDD must be risk-based to ensure that measures to prevent or mitigate money laundering or terrorist financing are commensurate with the risk identified. Terms should be explained, and processes should be documented for collecting due diligence and customer verification. This risk-based approach is an essential foundation for efficiently allocating resources and implementing regulatory measures. Enhanced due diligence, or EDD. With EDD, the identification of a politically exposed person, or PEP, is important, along with making the distinction between domestic Bermuda PEPs and foreign PEPs. Other factors should also be considered, such as a high-risk nationality, place of residence, or occupation. Ongoing monitoring. Companies must provide a customer review schedule in accordance with the assigned risk level. For example, 1, 3, and 5 years, or 1, 2, and 3 years for high, medium, and low-risk business relationships. Outsourcing. If outsourcing is used, whether intra-group insourcing or to an external third party, the respective roles must be clearly documented. If screening is outsourced, the regulated financial institution must have procedures to satisfy itself regarding the effectiveness of the third party's screening procedures in ensuring employee competence and probity. Additionally, there must be a Bermuda officer within the regulated financial institution who is responsible for overseeing any outsourced AML arrangements. Regulated financial institutions are ultimately responsible and can be held liable if something goes wrong in relation to outsourcing. Therefore, any outsourced or insourced functions must be appropriately monitored. Systems and controls. The regulations also discuss the systems and controls that must be in place and documented. These include a business risk assessment that must be updated at least annually or more frequently when the regulated financial institution's circumstances change. for example, with the addition of a new product or service. Finally, the regulated financial institutions should ensure that their independent audit and training obligations are adhered to, as well as the obligation to have a compliance officer employed at the managerial level who is adequately trained to carry out the role and is responsible for the AML/ATF program. Regarding supervision, the AML/ATF department has determined that the AML/ATF regulated insurance sectors have faced compliance challenges in relation to several regulatory obligations. These include policies and procedures. We encourage companies to review their policies and procedures against the regulations, particularly in relation to the listed obligations. Additionally, companies should perform regular gap analyses and specify any regulations that do not apply to them. Documentation. Document all relevant customer records, including identification, proof of residential address, corporate documents, risk assessments, evidence of screening for adverse media and negative news, PEPs, and any applicable sanctions, source of funds, and source of wealth. The documents must be available as either hard or soft copies if there is no evidence on file that the regulated institution carried out the process. This indicates to the regulator that the process did not happen. The Customer Risk Assessment (CRA) and BRA must minimally capture risks associated with the customer, geography, product, service, and delivery channel. Further, the BRA and CRA must be aligned and contain any other risk categories the company considers pertinent. Examples of customer risk are occupation, industry, and PEP status. Geographic risk examples are nationality and place of residence. Product risk examples are features of the products, like early surrender, etc. And delivery channel examples are due diligence provided via an agent or face-to-face AML/ATF, and sanctions audit gaps that are not properly captured. Audit reports should provide a detailed overview of any gaps or areas of improvement to the AML/ATF framework. A company's likelihood of having a gold star report is low. A detailed audit report helps a company to mitigate its money laundering and sanctions risks. The compliance officer and MLRO roles require additional training above and beyond the baseline training received by all staff members. In addition, when informing the authority about a change in personnel for the compliance officer and MLRO roles, companies are required to ensure the individuals are appropriately qualified with regard to sufficient AML/ATF and sanctions training and background. This slide briefly outlines the obligations AML/ATF regulated insurance sectors find the most challenging. However, before discussing this further, it is important to provide an overview of a few key regulations that the authority utilizes when assessing a regulated financial institution's compliance. Customer due diligence, or CDD. The application of CDD must be risk-based to ensure that measures to prevent or mitigate money laundering or terrorist financing are commensurate with the risk identified. Terms should be explained, and processes should be documented for collecting due diligence and customer verification. This risk-based approach is an essential foundation for efficiently allocating resources and implementing regulatory measures. Enhanced due diligence, or EDD. With EDD, the identification of a politically exposed person or PEP is important, along with making the distinction between domestic Bermuda PEPs and foreign PEPs. Other factors should also be considered, such as a high-risk nationality, place of residence, or occupation. Ongoing monitoring. Companies must provide a customer review schedule in accordance with the assigned risk level, for example, 1, 3, and 5 years, or 1, 2, and 3 years for high, medium, and low-risk business relationships. Outsourcing. If outsourcing is used, whether intra-group insourcing or to an external third party, The respective roles must be clearly documented. If screening is outsourced, the regulated financial institution must have procedures to satisfy itself regarding the effectiveness of the third party's screening procedures in ensuring employee competence and probity. Additionally, there must be a Bermuda officer within the regulated financial institution who is responsible for overseeing any outsourced AML arrangements. Regulated financial institutions are ultimately responsible and can be held liable if something goes wrong in relation to outsourcing. Therefore, any outsourced or insourced functions must be appropriately monitored. Systems and controls. The regulations also discuss the systems and controls that must be in place and documented. These include a business risk assessment that must be updated at least annually or more frequently when the regulated financial institution's circumstances change. For example, with the addition of a new product or service. Finally, the regulated financial institutions should ensure that their independent audit and training obligations are adhered to, as well as the obligation to have a compliance officer employed at the managerial level who is adequately trained to carry out the role and is responsible for the AML/ATF program. Regarding supervision, the AML/ATF department has determined that the AML/ATF regulated insurance sectors have faced compliance challenges in relation to several regulatory obligations. These include policies and procedures. We encourage companies to review their policies and procedures against the regulations, particularly in relation to the listed obligations. Additionally, companies should perform regular gap analyses and specify any regulations that do not apply to them. Documentation. Document all relevant customer records, including identification, proof of residential address, corporate documents, risk assessments, evidence of screening for adverse media and negative news, PEPs, and any applicable sanctions, source of funds, and source of wealth. The documents must be available as either hard or soft copies if there is no evidence on file that the regulated institution carried out the process. This indicates to the regulator that the process did not happen. The Customer Risk Assessment (CRA) and BRA must minimally capture risks associated with the customer, geography, product, service, and delivery channel. Further, the BRA and CRA must be aligned and contain any other risk categories the company considers pertinent. Examples of customer risk are occupation, industry, and PEP status. Geographic risk examples are nationality and place of residence. Product risk examples are features of the products, like early surrender, etc. And delivery channel examples are due diligence provided via an agent or face-to-face. AML, ATF, and sanctions audit gaps that are not properly captured. Audit reports should provide a detailed overview of any gaps or areas of improvement to the AML/ATF framework. A company's likelihood of having a gold star report is low. A detailed audit report helps a company to mitigate its money laundering and sanctions risks. The compliance officer and MLRO roles require additional training above and beyond the baseline training received by all staff members. In addition, when informing the authority about a change in personnel for the compliance officer and MLRO roles, companies are required to ensure the individuals are appropriately qualified with regard to sufficient AML/ATF and sanctions training and background. You may ask, what preventive measures and controls can a regulated entity take to prevent money laundering and terrorist financing? This slide explains the preventative money laundering and terrorist financing measures and mitigating controls a company should apply to prevent money laundering and terrorist financing. Insurers and intermediaries should assess and document the robustness of the AML/ATF framework. Additionally, ensure that your AML ATF policies and procedures are up to date with the legislation. This should also include sanctions policies. Insurers should ensure the appointed compliance officer, MLRO, management and staff, including board members, receive the appropriate AML, ATF, and sanctions training for their respective roles. Insurers should ensure policies and procedures are being appropriately implemented by performing quality assurance checks of the controls. Of course, every AML, ATF process should be documented. This assists with record keeping and tracking for reporting purposes. Another preventative measure is to ensure that the company has a well-scoped, comprehensive, independent AML, ATF audit performed annually by qualified persons. Additionally, companies need to review the audit results and resolve any outstanding issues. Please refer to the BMA guidance notes for further clarification on qualifications and independence. One of the top questions we receive at the authority is, how can our company best prepare for an on-site examination? At this time, the authority's AML, ATF team will review our off-site and on-site examination steps to better understand these processes as part of the money laundering preventative measures and controls. The BMA conducts on-site examinations, during which we review the AML, ATF framework to ensure it meets the legislative requirements. This preventative measure ensures companies operating within Bermuda are not misused for money laundering or terrorist financing purposes. Companies should be ready for the thorough examination process. This is a company's chance to demonstrate its strong compliance framework. It should be standard practice, as we only verify the standards companies have agreed to uphold as part of their licensing requirements. Additionally, the documented AML, ATF, and sanctions policies and processes should be reviewed at least annually to ensure compliance with the regulations. As part of the review, companies must demonstrate that the appropriate training has occurred. Interviews with senior management and select staff are also conducted during the on-site review. File testing submissions should be submitted promptly. Once the on-site has started, documents should not be modified except for a client request or business as usual. Key takeaways. You may ask, what are the key takeaways from this session? Companies should ensure that their business risk assessments are adequately prepared. The BRA goes a long way in helping to build an effective AML, ATF, and sanctions framework and setting the foundation for business. Getting the BRA right will assist with managing risks systematically to ensure a risk-based approach. With a greater focus on higher-risk relationships, it is also important to monitor the lower-risk relationships so that they do not fly under the radar and become problematic or the source of money laundering or terrorist financing. The BRA should be revisited at least annually or sooner. For example, if a relevant aspect of the business plan or legislation changes, we emphasize the preventive measures throughout the presentation. Understanding and implementing the regulations is also paramount to a successful AML, ATF program. In order to be well prepared for an on-site examination, conducting a gap analysis against the regulations is advised, along with actioning the points raised in your independent AML audit. The following slides are from the Financial Intelligence Agency and cover reporting of suspicious activities and transactions, along with typologies derived from these reports. Let's begin with an overview of SAR and STR filings submitted to the Financial Intelligence Agency from the first quarter of 2021 to the first quarter of 2024 by LTIs. There were 141 filings in 2021, 152 in 2022, and 223 in 2023. In the first quarter of this year, 72 filings were made, and 45 were made in the second quarter of 2024. During this time period, All of these submissions were filed by 17 leaders TIs of interest. One's TR was rejected in 2021 as it was filed without sufficient information. In the second quarter of 2024, 19 STRs were rejected due to insufficient supporting documentation for the SAR-STR narrative. In these cases, ASR was filed to seek advice from the FIA on the appropriate action to be taken. Please note that the FIA does not provide advice or recommendations. This slide provides an overview of SAR and STR filings submitted to the Financial Intelligence Agency by insurance managers. From the first quarter of 2021 to the first quarter of this year, there were 7 filings in 2021, 4 in 2022, 5 in 2023, 5 in quarter 1 of 2024, and none in the second quarter of this year. Notably, 10 insurance managers submitted all of the filings during this time period. An overview of SAR and STR filings submitted to the Financial Intelligence Agency by insurance brokers from quarter 1, 2021 to quarter 2, 2024 identified only 1 filing in 2023. The 4 long-term insurer trends that we have identified in these filings include adverse media involving actual or alleged money laundering, terrorist financing, and predicate offenses, refusal to comply with FATCA requirements, fraud involving fictitious or fraudulent documents, and consent requests were filed due to adverse media. In the case of Overseas Financial Intelligence Unit (FIU) requests for information, there have been instances when LTIs and overseas FIUs have filed information with the FIA about the same person, company, suspect activity, or suspect transaction. Notably, a trend identified across all reporting sectors is clients' refusal to comply with customer due diligence requirements. Subsequently, the reporting sector identified this refusal as suspicious activity. Insurance manager trends. 2 trends identified in the filings include declined business due to suspects' activity and fraudulent activity. One example of declined business involved a potential client who refused to provide CDD and KYC documentation for the purchase of a local property and requested to pay for a mortgage through cash transactions. Examples of suspected fraudulent activity include suspected fraudulent wire payment requests, adverse media identifying that letters of credit used by the entity may be fraudulent, and the provision of false information in response to previous KYC documents requests. Insurance broker patterns. As there have only been 2 filings from insurance brokers to date, we will highlight the 2 patterns that have emerged for insurance brokers. Firstly, there was a fraudulent claim made under an insurance policy. This issue will be further discussed in the insurance broker typology section. Additionally, there was a request to broker the placement of a portion of the reinsurance for a property insurance risk and to involve sanctioned entities as ultimate stakeholders. We will now move on and review an LTI typology involving a consent request and suspected fraud. In July 2021, a long-term insurer received a request to surrender a life insurance policy while conducting due diligence in processing the request. The insurance company conducted a Bridger scan. The research demonstrated a positive match of the insured and beneficial owner, Mr. C, to a relative or close associate of a PEP and a special interest person with alleged involvement in a Hawala scam. The policy was issued in 2010, and the current net cash value of the policy was USD $2.5 million. The director, sole shareholder, and beneficial owner of the corporate policy owner, Onyx Ltd., a personal investment company, is Mr. C, who resides in the Caribbean. According to open source information, The subject was referenced in an investigation conducted by Asian authorities into an alleged hawala scam in 2016. Together with his relatives, they were suspected of having been involved in laundering large amounts of money through front companies in Asia. The laundered money was believed to have originated from bribes paid in another legal case under investigation. Additionally, the LTI personnel processing the surrender request recognized the following red flags as suspicious. The surrender was requested as a rush. In reviewing the ownership structure, the owner of the policy was struck off and then recently reinstated. The original bank account provided for the owner of the policy at the time of onboarding is reportedly no longer open. The client has requested an exception to pay the owner and would like the funds to be remitted directly to his bank account in Europe and, while reviewing the surrender request, the client submitted a transfer of ownership to the master trust. As this was an unusual request, the employee processing the surrender inquired why the client wanted to transfer ownership at this point. The response was that they thought it would speed up the surrender process, which did not make sense to the employee. The ownership transfer was never completed as the employee informed the client through the distribution firm that it would not speed up the process and was unnecessary. As a result, the LTI is concerned that the client may be committing the following offenses under the Proceeds of Crime Act 1997, Section 43, which relates to the concealment or the transfer of proceeds of criminal conduct, and or Section 45, which refers to the acquisition, possession, or use of the proceeds of criminal conduct. Report indicators selected by the LTI to identify the characteristics within the narrative of the STR included adverse media, use of insurance products, PEP foreign, money laundering, beneficial ownership, and the foreign agency contacting the reporting entity. Actions taken by the FIA as a result of this filing included: a non-consent letter was provided to the LTI. As a result, the LTI was not permitted to conduct the surrender request without consent over a 45-day period. 6 Egmont financial intelligence units were notified of the suspect activity and the Bermuda Police Service was notified. In conclusion, since no interest was shown in the suspect funds and the respective subjects and entities involved before the lapse of the 45-day moratorium period, consent was obtained to send the funds to the beneficiary financial institution. Key takeaways: thanks to the excellent details and supporting documents provided with the STR filing, the FIA made 6 other countries and local competent authorities aware of the suspected financial activity linked to the policy and the related parties. Although Bermuda authorities did not confiscate the funds and overseas authorities showed no interest, sharing this intelligence can be an asset for future and ongoing investigations on this matter.
Let's review a typology involving an STR filed in 2022 by a local professional services firm on behalf of an insurance manager in liquidation. The filing reported adverse media involving allegations of embezzlement and tax evasion in the USA that have been linked to their client through her spouse. Although the client holds the contract and made the withdrawal request in 2022, the client's spouse is listed as his beneficiary on the policies held. At the time of this filing, the liquidator did not distribute funds to policyholders. Report indicators were selected on behalf of the insurance manager to identify the characteristics within the narrative of the STR, which included adverse media, embezzlement, and tax evasion. Actions taken by the FIA as a result of this filing included: a spontaneous disclosure was sent to 2 overseas financial intelligence units. A spontaneous disclosure was sent to the Bermuda Police Service. Key takeaways: thanks to the thorough and well-supported disclosure provided by the local professional services firm on behalf of the insurance manager, it is anticipated the disclosure to local and overseas authorities will provide insight into the financial activity of the client and her spouse as it pertains to financial, inflows, and outflows from Bermuda. It is also intended that the information herein will establish if a predicate offense has taken place in the two jurisdictions. If so, it will assist with an ongoing criminal investigation or commence a criminal or civil investigation. Let's review a typology involving an STR filed in 2019 by an insurance broker. The filing reported a fraudulent claim under the insurance policy. A client made a claim under his insurance policy for an expensive watch that he claimed had fallen overboard while on a cruise. Upon further investigation and requests for additional supporting documentation, the client stated that he left the invoice for the watch purchase in New York to avoid paying customs duty. He intended to have the jewelry appraised locally to get it insured. Red flags of suspected fraudulent activity identified by the insurance broker included: the clients had an aggressive attitude and threatened to get lawyers involved. Further investigations into the claim identified adverse media linked to drug trafficking. Google searches and a social media review of several pictures of the client showed no evidence of him wearing the bracelet, despite his claim that he wears it all the time. The client evaded the customs duty payment. Report indicators were selected on behalf of the insurance broker to identify the characteristics within the narrative of the STR, including fraud. Actions taken by the FIA included a spontaneous disclosure that was sent to local law enforcement. Quality of SAR and STR filings. The quality of SAR and STR filings from January 2021 to Q1 2024 has been consistently high. Only one report was rejected as the incorrect report type was selected. As a reminder, always provide any supporting documentation, for example, copies of IDIAS, account opening documents, and adverse media links, to support the narrative of the suspicious activity report. This information assists with the FIA's analysis and disseminating informative disclosures to the competent authorities in Bermuda and other jurisdictions. We would also like to stress the importance of providing the respective supporting documentation and the following bank account details for the beneficiary bank or institution: beneficiary bank name, beneficiary bank address, beneficiary account number, beneficiary account name, amount and currency involved, intermediary bank, IBAN or SWIFT code, upcoming actions for the FIA. The FIA will be providing guidance to LTIs about introducing a new type of STR report to be used specifically for consent requests. This report will help the FIA analysts readily identify consent requests instead of relying on mentioning the term consent request within the STR narrative and/or selecting the report indicator called consent request. SAR and STR filing reminders. Firstly, when the ITI seeks consent due to pending suspicious transactional activity, it is important to submit a suspicious transaction report (STR). The STR allows for suspect transactional activity to be inputted into GOML and for the FIA analysts to readily identify the suspect amount in question. Secondly, report declined business to the FIA when adverse media or suspicious activity is identified. Also, remember to keep a declined business log as mandated by the Bermuda Monetary Authority. This log may provide value for future analysis or investigations by the FIA or the Bermuda Police Service. Lastly, the FIA discourages filings based solely on a potential client's refusal to provide CDD or Know Your Customer information when no suspicious activity can be identified. In this slide, you will see insurance sector specific resources that will be helpful when reviewing your AML/ATF framework. These include links to the BMA website and our general and sector-specific guidance notes for the insurance sector. This slide also shows other useful links, including the FIA website, a Financial Action Task Force report on guidance for a risk-based approach for the life insurance sector, and the CFAT website. In conclusion, the authority has spent time today discussing MLTF sectoral risks and red flags, supervisory insights, and preventive measures. The Financial Intelligence Agency has provided trends, typologies, and reporting information. Collectively, this is information to consider when revising your staff training and AMLATF policies and procedures. We hope today's presentation will help enhance your company's systems and controls and improve AMLATF compliance in the future. From a regulator's perspective, we are here to assist you in achieving these objectives. From a national perspective, we each play a role in strengthening Bermuda's AMLATF framework and keeping malicious individuals at bay. To achieve this, we must invest time in enhancing our AMLATF, sanctions, and regulatory compliance to make our companies more resilient. We can expect improved business outcomes and enhanced reputational benefits by strengthening our systems, controls, and reporting processes. We invite you to join us on this journey for the good of your company and Bermuda's reputation as a highly respected international financial center. If you have questions you think of later, please do not hesitate to contact your industry association or the BMA directly at aml@bma.bm or the FIA at info@fia.bm.